Central banks, on an average, buy 400 tons of gold every year. This is the 25-30-year average. But in the last 3 years, they have averaged anywhere between 1,000 to 1,100 tons per year. So you can imagine the leap in the quantum of central bank buying.
Gold and silver. Both metals have been on quite a rally this year, raising questions about what's driving the move and how investors should respond. And to help us make sense of it all, we have with us Vikram Dhawan. He's head of commodities at Nippon India Mutual Fund. Welcome, Vikram.
Thank you, Ruchira, on inviting me on your show.
Great to have you here. Let's begin with the surge. Gold and silver, both the metals, they've been on quite a rally this year. What do you think is behind the surge, and how do you see it lasting?
There is a global reset in asset allocation, and this has been happening with the central banks for quite some time. It is not just past few years that central banks have been increasing exposure to gold. If you go back, way back in 2017-16, that is when actually the surge happened. Post the great financial crisis and post-COVID, which led to a lot of volatility in treasuries and dollar. The central banks wanted to decrease their exposure to US dollar. For instance, 25, 30 years back, a typical central bank balance sheet used to have about 75, 80% dollar, US dollar treasuries, and rest was all other currencies and gold. Today, the average US dollar treasury holdings have come down below 60%. So this has been a gradual process, which has as I was mentioning, the global reset of asset allocation happened almost a decade back for the central banks. It is just in the past 1 year it is shifted to the mainstream. Very specifically, middle of last year, there was a study done by a few leading banks in the US, and the study gave very interesting figures that 70%, roughly 70% of the managed wealth either had very little gold or no gold or silver in their portfolio. So you can imagine, just a year back, the world was sitting either underweight or without any exposure to gold and silver, and from there, it has been from being underweight or zero weight to at least being equal weight, which explains the market where what is happening. Until the time this asset allocation continues globally, the reset continues, the markets will continue like this, and it's very difficult to assess when this will plateau out because we don't know where they are right now. But so far, the global reset in asset allocation continues.
But when prices are already high, a lot of investors, they hesitate to enter. So how should one approach gold and silver now without risking a peak entry?
So I think, first of all, there are two themes over here. One is the asset allocation theme.
Yeah.
That are you buying gold for asset allocation? And obviously, even at these high prices, the central banks bought roughly about 400 tons of gold in first half of this year. The ETFs bought about another 400 tons of gold in this H1 this year. So clearly, some allocation is price agnostic because you want to diversify your portfolio. Ideally, it should be done when the markets are low, but it never happens, never works out that way. Some allocation will occur, it's irrespective of the price. To the extent of the minimum allocation targets each investor has, the motivation for that would be managing the risk in your portfolio and trying to reduce the volatility in your portfolio and trying to bump up the what we call as the risk-weighted returns. Each investor who's convinced, first get yourself convinced that is gold and silver a good diversifier. And once you're convinced, then I think, unfortunately, the prices are very high, but they keep on moving up every day. So there has to be some sort of, a minimum allocation, which the target has to be there in the investor's mind.
The thing is that both these metals, they behave very differently in volatility and in how they move with equities in their long cycles. So how should investors think about dividing their exposure between the two metals?
I think there are for certain thumb rules, very basic thumb rules that you may want to consider. First of all, try to find out the volatility of your portfolio. And whatever is the volatility of your portfolio, and see the cyclicality of your portfolio. I mean, is it every 3 years or 4 years it goes a correction, or 5 years, whatever is that. So then, based on that, you will realize what is the minimum allocation you need to do. Now, various studies have been done, and there was one done by the World Gold Council. And the study they did was that for a typical Indian pension portfolio, allocations below 5% and allocation above 15% were suboptimal. So they gave a range of 5 to 15%. But again, don't take that as the sacred word. Do your own analysis. But I think at the end of the day, it is statistics and mathematics that find out what is the optimum allocation to gold in all the scenarios which have happened in the past, and you will arrive at a number.
Okay. The thing with gold and silver is that a lot of people, they still prefer holding them in physical form. But in today's world, do you think that still makes sense, or has the logic changed now?
Those investors which believe in wealth creation through capital markets, for them, holding physical gold is not a very clever idea, because what happens is that, let us say, if the risk assets enter into a corrective phase, then since physical gold, you can't actually mark, it'll be a theoretical mark to market. You don't know at what price you'll be able to get rid of that. It will not be as liquid as gold or silver ETF. So I think to the extent of the investment which you're doing as part of your portfolio diversification or asset allocation, avoid physical gold. Obviously, to the extent of the consumption, which could be in form of jewelry or ornaments or gadgets, etc., obviously you need physical gold. So it has to be a combination of both.
Coming to ETFs, they have made access to these metals really simple. So beyond convenience, what should investors actually pay attention to, and how can these instruments be used effectively within a broader asset allocation strategy?
So I think one of the reasons why people like gold and to a large extent silver is because of the liquidity. I mean, they are fungible with cash. And that is why, a gold bar is a gold bar anywhere in the world. But, you can take a bond or a stock of a country, and some region of the world, it may not have any value. And for crypto, when the lights go out, there's no crypto, right? So that's why, these are very sacrosanct, sacred, long investment with a very, very long history of thousands of years. I mean, they were considered as money at some point of time. So I think liquidity is the main issue. Whatever form of gold you are buying into for investments, liquidity is of the supreme importance, because, as I mentioned, you would need to only disturb your precious metal portfolio only when the risk assets are getting volatile. And at that point of time, if you are not able to get rid of the precious metals, because obviously you would need to get rid of them if you want to raise cash. Secondly, I think from the point of view of the portfolio, also look at it from the point of view that are you exposed? Well, we all are exposed to currency depreciation, but how much of your portfolio is directly linked to currency depreciation? For instance, in 2024, while the dollar gold prices had gone up by 25 odd percent, in rupee terms it was close to 29%, and in Turkish lira it was about 51%. So you can imagine that probably if you would have had gold in your portfolio, whatever damage currency depreciation would have done to your portfolio or your lifestyle or your expenses, you would have more than recovered it from gold. So, these 2-3 things, because we always, underestimate the impact of currency devaluation or depreciation on the personal portfolio and personal purchasing power. So that is another angle that you need to keep in mind.
Finally, over the long term, where do you see gold and silver fitting in? Are they diversifiers, tactical plays, or part of an investor's core holdings?
The global sovereign debt today is $105 trillion. At the beginning of the century, it was about $30 trillion. So we have added $80 trillion in 25 years. And it is expected to more than double in the next 25 years. One of the reasons you want to hold precious metal is because they don't have credit risk. So what is the antidote or what is the hedge against debt? Because debt can only go sour if there's a credit event. So how do you protect yourself from a credit event? It's precious metal is one of the ways. Now, that is why the global reset is happening. It started with the central banks because they were worried about, there was a survey done by Bloomberg last year, roughly about 37% of the central banks flagged the debt load of the world to be a problem. That figure has gone to about 43% in 2025. So I think more than the returns, I would say that if you are convinced about, for gold, it is the debt. For silver, it is the climate issue because, again, temperatures across the world have gone up in 2022, 23, and 24. The average temperatures of the world were about 1.5 degree higher. And these kind of temperature rise can result in anywhere between $300 to $900 billion worth of economic output damaged or lost every quarter in terms of higher energy consumption for more cooling, in terms of crop cycle disruption, etc. And obviously, the consequential damages the climate has. So, if these themes are what are driving the allocation to gold, I'm not too sure people are buying gold and silver for returns. They are basically saying that, look here, I've got, lots of other asset classes, but do I have an asset class which can take care of these couple of risks? So, okay, why don't we add some that? So I think this is what is happening. So I guess from a portfolio point of view, from a hedge, from a climate hedge, from a debt hedge, it's a very compelling story. And whatever returns you make will be bonus.
All right. Well, that was a great perspective on how investors can think about precious metals, not just as safe havens, but as part of a thoughtful portfolio strategy. Thank you, Vikram, for joining in.
Thank you very much for inviting me on your show. Thanks a lot.